Hello everyone, welcome to episode 3 of Tax Talk. Today we're going to talk about what to do with your taxes if you're a real estate investor, and which means you need to claim income for lenders and you need to save on your taxes. Now don't forget to like, share, comment, subscribe, and press the notification bell so that you can be the first person to be notified when we upload new videos. Let's get started. You are a real estate investor, and part of being a real estate investor is that you're constantly buying property. Sometimes you're one of those people, one of those investors who doesn't like to buy a lot of properties. This is not for you. But if you're constantly having to buy property, which means that you're constantly buying new houses, new properties, new duplexes, new quadruplexes, which means that you're constantly applying for loans, right? And lenders need income to be able to lend to you. They need income, right? So what does that mean? That means you cannot claim losses, cannot claim in so much losses that you're in the negative. You cannot claim so much losses that you have $10,000 in income. You cannot claim so much losses that you only have $50,000 in income. You can't claim so much losses that you only have $100,000 in losses, right? And depending on how much, how many loans you have already, what your monthly payments are, what your liabilities are on those, and your other liabilities, right? It limits how little your income can be, because the lenders, they do have to follow the debt to income ratio, and they are a stickler to that point. Debt to income typically under 45%. So what does that mean for you? Because you don't want to be paying taxes on all that income when you have depreciation. If you're constantly buying property and you're constantly investing into it and you're constantly putting money into it, and you want the benefit of depreciation, right? Because it's a business expense. It's a business expense that you are delaying recognizing, because it's an asset. It's an asset, but it's also a business expense. You had to put money into all of that. The loan that you're putting in, the principal of that, the interest of that, those are the business costs, right? You bought the real estate, right? But you didn't put all the costs on it ahead of time, right? You're having to take the cost, the cost and pay it later. And that later that you're doing, that's what you need to get off. The principal that you're paying, that is the expense that the depreciation is allowing you to recognize, right? That is the expense. You are paying actual money on that property. So that means? That means you want to get it off. You want a deduction for it. But your real estate lenders don't want to lend to people who don't have income, right? Because how do they know they're able to pay it back? They don't. So you have to show income. So how do you show income to your lenders and reduce your taxes? The answer is credit. So in taxes, we have income, we have deductions, and we have credit, right? Income and deductions, they basically work like your income and expenses. Your income and your expenses, boom. But the credits apply to your taxes. Basically, it means that, okay, you owe this much taxes, but we will allow you to reduce those taxes. That's what credits are. So credits affect your actual tax. Once your income has been set, once your net income has been set, credits affect your actual taxes, right? So instead of focusing a lot on deductions, which is going to reduce your expenses, focus more on credits. Focus more on credit. And when you do credits, that means you can claim sufficient income, but still pay less taxes. That's just a quick thing that I wanted to mention today. Thank you for listening. That'll be all for today. And don't forget to like, subscribe, share, and comment. Bye for now.